calculate or interpret effective tax rate on a given currency unit of corporate earnings under double taxation, dividend imputation, and split tax rate system. So the first one is the double taxation system. Here in this taxation system is implied in most of the countries. Here, the first tax is the corporate tax that has been issued by that the company has to pay on its net and on its earnings. Suppose the company has earned $100 and the corporate tax rate is 35%. So the $35 has been paid by the company to the government, and the remaining amount is $65. So the $65 is net income, and suppose companies issued 100% payout ratio. That is, company distributed $65 to its shareholders. So there, the shareholders will be get taxed on the dividend tax rate. Suppose the dividend tax the individual tax rate is 20%. So on the $65, the shareholders will be taxed. So that is why the earnings has been taxed two times. So it is known as double taxation systems. So let's read what it is given over here. The dividends paid in US are taxed according to the double tax system. First, tax paid by the firm on their earnings, that is the corporate tax rate, and second, tax paid by the investors who receive the dividends from the earnings of the firm. So this is the formula of the effective tax rate. It is the corporate tax rate plus 1 minus CTR into ITR. ITR is the individual tax rate and CTR is the corporate tax rate. So here is the sum, but we'll not go with this formula. It's basically an easy sum we can do based on our understanding. So here the earnings is $300 and the corporate tax rate is 35%. The corporate pays 100% dividends of earnings. Calculate the effective tax rate where the individual has to pay 15% tax on his dividends. So here we have given three things. First is the earnings of $300, on which the $35, 35% will be taxed. So let's calculate how much it's gonna tax us. So here is the financial calculator. So the $300 into 0.35 first will do 300 into 0.35. Okay. So the first taxed amount is 105. So 105 will be given. So 105 is the taxed amount. So we'll store in the STO1. And so what will the remaining amount will be passed on to the shareholders? So it will be 105 minus 300, which is equals to 195. So this is the 195 will be passed on to the shareholders. But here we have mentioned that the corporate pays 100% dividends of its earnings. So this 195 will be the full amount of $195 will be given to the shareholders. So after the 195 is given to the shareholders, they have been taxed at 15%. So we'll do 0.15 of 195. So we will got a 29.2. So we'll store it as 202. So the total amount is equal 1 plus equal total tax we have paid is $134.25 on $300 earnings. So we'll do 134.25 divided by 300, which is equal to 44.75%. So so on $100 of earnings, 44.75 will be taxed, and the remaining will be given by the will be received by the shareholders. Okay, so let's go with the second page. So the second system is split rate. Here, if the company pays dividend from its earnings, will have to pay lower CTR other than if they retained earnings. So here the tax will be depend on if the company pays dividends from its net income or not. If the company pays zero dividends, then they will be taxed the percentage greater than if they pay dividends. Suppose a company pay dividend will be taxed at 20%. If the company don't wish to pay any dividends, it will be taxed at 30%. So here we have got a sum. Here you have given $300. The corporate tax rate is 35% on retained earnings and 20% tax on dividends. Payout ratio 50%. Interest tax rate is 30%. Calculate the effective tax rate. So this is a trick question. Here we have to first calculate the payout ratio is 50%. So the 50% of 300 will be 150. So tax 150 will be given as dividends. So here we have to calculate the effective tax rate that has been borne by the investors. So the 150 that has been retained, those tax will won't come into this sum. So let's first calculate the 50% of 300 is 150. So it will be 150. 150 into first tax is tax on dividend, that is 20%, is 30. Store and store one. 30 minus 150 is 120. So 120 into the individual tax rate is 0.30, 0.3, equal to 36. Storage stored plus resolve one. Total tax is 66, and we will be dividing by 150. Okay. That comes to 44% is the effective tax rate that has been borne by the shareholders. So the one tax will first will be borne at the corporate tax rate, second is the individual tax rate. So here we won't consider the 150 that has been retained. So that calculation won't come into this sum. The last system is imputation tax system. Here all taxes are paid according to the shareholder tax. Suppose your tax bracket comes under 10%, so like you have to pay 10% tax, but the company is bound to pay 35% of corporate tax rate. So at the end, you will be given 25% extra. So what we have to suppose the company has paid, suppose company has earned $100 and they have been taxed 35%, but your tax rate is 10%. So the extra that has been that is extra that the extra amount that has not been passed to you will be as DTA. So that what is DTA to suppose the earnings is $300, the corporate tax is 50%, payout ratio is 100%. Person with ITR is 20%, person with ITR is 60%. So the total effective tax rate will be 20%. So if you paid higher taxes, uh, that will be created as an DTA. If you have paid lower taxes, that will be created as DTA. So the next uh, LOS is LOSC compares stable dividends versus constant dividend payout ratio. So here we are talking about the payout ratio of different companies. First company is paying dividends, paying stable dividends. The second company is paying constant dividends. So here we have discovered what is stable dividends and constant dividends. So the stable dividend policy focuses on steady dividend payout ratio, even earnings are volatile. Suppose, as you know, the business cycle, there is a boom business, there is a boom, and there is a recession. So the company focuses on stable dividend policy will give stable dividends, even though there is a boom or a recession. So the company aligns the dividend growth rate with company's long-term growth rate of earnings. So target payout adjustment mode. Okay, so this is the formula where we can calculate the future dividend that the company is gonna pay if we know the company's target payout ratio. Suppose company focuses on long-term payout ratio 60%, but currently the company's payout ratio is 20%. So there is a gap of 40%, which will be accomplished during the period of years. The earnings are expected to increase and payout ratio is below the target payout. So one can estimate the future dividends by the formula. So this is the formula increasing dividends in terms of dollars. So we get to know what will at what amount the dividend will gonna increase from the previous dividend paid. So the expected earnings. So what will be the expected earnings? So the target payout ratio minus previous dividend divided by 1 by n. The adjustment factor is 1 by n is equals to 1 by the number of years over which the adjustment in dividends will take place. So here is the sum. Previous earnings is $3.5. Dividend paid is 0.7. This is the past data, all this is the past data. Okay. The current year expected earnings. So the current year expected earnings is 4.5%. The target payout ratio. So this is not the current payout ratio, but we will find what suppose the current payout ratio, target payout ratio is same. So what will be the dividend we gonna expect this year? So to achieve to the target payout ratio, company will gonna require 5 years. So let's calculate. So the previous year earnings people for dividend payout is 0.7. The current year earnings is $4.5. So this is the amount the company has earned into the payout ratio is 0.35. So this is the dividend we will gonna expect, but this is not the dividend we're gonna get. So the current payout ratio is different from the target payout ratio. So we will minus the previous dividends we have received. It's the 0.7. Okay, that's the 0.875 and divided by total number of years is 5. So we will get 0.1 cent per dollar. So the previous dividend we have received 0.1, dollars plus 0.175. So, so plus 0.175. Add zero point 0.7 the previous dividend. So this is the so 0.875 will be the dividend we will gonna receive this year. Let's check. Okay, that's how they have calculated the $4.4 of the expected earnings into 0.35 minus 0.7 into 1 by 10. So current dividend will be previous dividend plus dividend increase. And the second is the constant dividend payout ratio policy. Their company pays a constant of earnings as dividends, pay 20% of earnings as dividends as every year, even though their earnings are volatile. Okay, that's an easy statement. So the next LOS is LOSH. Describe broad trends in corporate payout policies. A lower portion of US companies pays dividend compared to their European counterparts. Globally, trends of paying dividends is in developed market is downward. So in developed markets, companies are not paying dividends. Stock repurchases trend is upwards. So the company has a certain amount in shareholders' equity. So the company is more focusing on repurchasing of shares because the company believes that their company is financially strong and they will earn a bit much better return on our stocks rather paying dividends. So next LOS is LOSI, compare share repurchases method. So how companies are uh, buy, uh, buying their shares back. So there are four methods. One is the open market transaction. So the open market transactions are often costly and can lead to several costs. First, like if the company wants to buy 1 million shares of its own company, so the company cannot directly put the market order and buy back its own shares. This will lead to increase in price of their share market, and they will get the shares at a very higher prices. So one is the open market transaction, flexible approach, buy directly from the markets. Second is the fixed price tender offer. So the company uh, issue a tender offer in which company invites all the investors to participate in this buyback offer. The company buyback its shares at a premium price. Good process. Third one is the Dutch auction. Company offers a range of price in investors agrees to sell the shares. Say company wants 1,000 shares, price ranges from 900 to 1,000 per share. Those 900 shares are ready to sell at 950. 900 shares are ready to sell at 960. So the company will execute this 960 dollars per 100 shares. The company buys all 1,000 shares price at the price of $960 per share. So next one is the repurchases for direct negotiation. Suppose there is institutional investors who have a good amount of shares, say 2 or 3% the company's shares. The company will directly negotiate it with him. So the company will offer a certain price to that so that they can directly buy back their shares. So purchasing from major shareholders like fund houses or HNIs. It is high net worth. Next one is the lowest share. Calculate and compare the effect of a share repurchase on an ATS. If the company buybacks its own shares, the uh, common shares in the market will decrease and the EPS will increase as the amount of EPS is net income by average common shares outstanding. The repurchase of shares using surplus cash or retained earnings will lower cash in the shareholders' equity, will lower cash and shareholders' equity. increase the firm's leverage, that is debt by assets. If company uses its surplus cash to buy back its own shares, assets will fall, so the debt to asset will rise. Debt to equity will rise because the shareholders' equity will fall if company buy back its own shares. Due to which the EPS will increase due to fewer shares. If the repurchase made by using debt, so net income will fall if the company is to use debt, because the company will have to pay interest on its debt. So the year EPS will only rise if the interest rate on debt used for repurchases is lower than the earnings rate. So what is earnings? Earnings rate is equal by the market price of the share. So if the interest rate is lower than the earning yield, then only the EPS will rise. In the sum, here we have 10 million shares. A company is having net income of 50 million and 100 million excess cash. So the company is having $100 million of cash. The company wants to repurchase it, 2 million shares at a premium of 25%. So what will be the market? So what will be the price of the stock that the company is ready to pay for it? So if the price of the share is $100, the company is ready to pay a 25% premium, which is $125. So let's see what the current market per share is, $40. So the company will pay 40 into 1.25. Okay. So we have to calculate what will be the effect of repurchase on EPS. Through cash, first is like we have to calculate the effect of repurchase. Uh, if we if we buy back the shares using the cash surplus that we have, and second one is the we're gonna raise debt, and the after cost tax interest rate is 3%. So we're gonna raise 3% debt of 100 million to repurchase the shares. So these are the two cases. So let's calculate the current EPS. The current EPS will be the current market price of the share is $40. And okay, the formula of EPS is net income by common shares available. So the net income is 15 million and 15 million and uh, 10 million is the outstanding shares. So the current EPS is $5 per share. Okay, so now company has buyback 2 million shares at a price of 40 into 1.25. So 40 into 1.25 $50. So the company has buyback for 40 million shares. Repurchases 22 million shares. So you have the 50 into 2 million. So the total cost the company has to bear is 100 million. So the 100 million is required to repurchase 2 million shares. So the company has $100 million as cash. So if we buy back the share using cash surplus, then our equity will gonna fall. Okay. So we'll calculate the EPS. So the EPS is net income by shares outstanding. So the net income which won't change. So the net income will be 50 and the shares will decrease. So there first there were 10 million shares and now it will be reduced by 2 million shares. So it will be 50 by 8, which is 6.25. As we can see that the EPS, the EPS after the repurchase has increased significantly. That is the EPS before the repurchase. In second case, we're gonna take a debt of 100 million at an interest rate of 3% to buy back 2 million shares. So using that 100 million fund is required for repurchase, we have to bear 3% interest rate. That is 3 million. 100 into 0.003 is 3 million every year, which will be deducted from our net income. So as you know that net income has a component of interest also. So there our interest will gonna increase by 3 million. So the our net income will fall by 3 million. So the net income will be 50 minus 3, 15, the usual net income 50 minus the interest that extra we're gonna bear. So that will be 47 and the outstanding shares also will be reduced. So it will be 47 by 8. So the EPS will be 5.875, which is still greater than the previous EPS, which was $5 per share. So here we want to calculate earning yield, EPS by NPS, 5 by 50 is 10%, and the interest rate we are going to pay is 3%. So our earning yield is greater than the interest rate, so our EPL will rise if we use it. So in using both of these methods, we can give the conclusion that our EPS will increase. Let's go to next page. Since we use debt for repurchase of shares, it increases company's leverage, though EPS rises but does not increase shareholders' wealth. As you know, we have taken a debt, so the debt to equity ratio is gonna rise. Even though our EPS will rise, but our company's financial leverage will gonna rise. So the next LOS scheme, calculate effect of a share repurchase on book value per share. So what will be the effect of repurchasing repurchasing own share on the book value of the company? So as we know that after stock repurchases, number of shares outstanding will decrease. And book value per share also changes because uh, uh, if the stock price is greater than the book value. Suppose the book value, that is the real value of the company, is $100, but the stock price is trading at 120. So the stock price is trading at a premium as comparison to the book value. So if the stock price is greater than the book value, then book value will fall if we repurchase the share. And if stock price is less than book value, then book value will gonna rise. Here I'll explain you the concept of this. Suppose the repurchase is how the repurchase is going to take place. The repurchase is going to take place like you want to buy back a share from the market. If the stock price is greater than the book value, then we are buying our own shares at a premium. But the real value of the company is not what the stock price is reflecting. So that's why our book value will gonna fall. Suppose if our true value of the true book value of our company is $100, but our stock is trading at $90. That is $10 discounted. So if we buy back our own shares, our book value will gonna increase because we are buying a good investment because the true value of the asset is $100 and we are getting at $90. So let's see the question. Here the stock price of Alpha and Beta is $20. Number of shares is same 11 million and the book value is 15 million, another is 25 million. So this is the true value of the company. So we're gonna divide 15 by 1 million, that is $15. $15 should be the book value per share and $25 should be the book value per share of beta. So as we can see that the alpha stock is overvalued because the true value is 15, but the stock price is $20. And here the beta is $20, which is undervalued. The true value is $25. So here we calculate book value per share, $15, $24, number of shares repurchased. So here we can see that is the number of both companies repurchase the shares worth of 5 million. So we will gonna divide 5 million by 24 alpha and 5 million by 5 million by 25 for beta. Okay. So 5 by 20 is 250 shares for both alpha and beta. So the number of shares outstanding will be 1 million minus 250K. So both the shares will be 750K, 750K. But the book value per share after the buyback is 15 minus 5 upon 750. That is the book value per share 15 minus $5 million that has been buyback. So the divided by 750 is the total shares outstanding. So the its book value is $13.33, but the previous book value was $15. So as you can see, the book value per share has drastically fallen because the stock price was overvalued. And here, the previous book value was $25, and after the repurchases, it is $26.67. As you can see, that we have made a good investment in our own company. Our book value has increased. After buyback, overvalued shares, book value falls, and undervalued book value rises. So let's go to next LOS. LOSL. Explain the choices between paying cash dividends and repurchasing shares. So first one is the tax advantages as LTCG is less than dividend tax. So share repurchases is preferred over dividend taxes because the investor will want to be come under the high tax bracket. If the company wants to signal the investor about it, about how the company is financially sound, so the company buyback its own shares gives the signal to the investor that the company is so strong about it, the company is so strong about its fundamentals that they are buying their shares back. Okay, so to give signal to the market that company sees its stock as a good investment. This tactic is used when share prices is declining and management wants to convey confidence in the company's future to investors. Its third one is the flexibility. As dividends, as if the company pays a dividend, it will give a signal that the company is committing that they will gonna pay dividends in the coming future. While share repurchases are not, if a company share repurchases its own share, it doesn't give a signal that company will continue repurchasing its own shares in the coming future. So when the stock price is low to benefit shareholders, it totally depends on the condition whether dividend or stock repurchases are good. So they could declare small dividends and should repurchases left out early. Second, last one is the offsetting. Fourth one is the offsetting dilution for ESOP. Suppose the company generally has 10% as ESOPs to its employees. If the ESOPs have been exercised, then the number of shares outstanding in the market will be increased and the EPS will gonna fall. So the company will try to offset this ESOP ESOP will getting diluted by repurchasing import shares and to bring back the EPS to the previous state. Okay. This one is the increasing financial leverage. Repurchases done by debt leverage, the company can move to its target debt to equity ratio by increasing debt. So let's go to next LOS, LOS and calculate and interpret dividend coverage ratio based on net income, free cash flow, identify characteristics of company that may not be able to sustain their cash dividends. So the dividend safety is the metric used to calculate the probability of dividends continuing at the current rate for the company. So the dividend payout ratio is dividend paid by net income, and the dividend coverage ratio is the inverse of it. So the dividend coverage ratio is net income by dividend paid. So the higher payout ratio than usual payout ratio indicates dividend but in future, when using this metric, you should compare the company with its peers for making judgment. Stable dividend providing companies look favorable and dividend cash company looks unfavorable because it's just a negative signal. And the FCF is the free cash flow. Free cash flow is available to the equity shareholders. It's the amount of cash flow available to distribute to equity shareholders after capital and working capital. So FCFE represents cash available for dividends and share buyback. So the company pay dividend from FCFE and repurchase through FCFE. So what is FCFE formula? FCFE formula is cash flow from operation minus CapEx plus net borrowing. So this is the CFA level 1 formula. So what is the FCFE coverage ratio? FCFE coverage ratio is FCFE by dividends plus share repurchases. Unlike dividend payout ratio, FCFE considers both share repurchases and dividends. FCFE coverage ratio is significantly less than when signals unsustainable. So if the FCFE value is below 1, which means numerator is less than denominator, which means the company has a company is not capable to pay the dividends from the FCFE. So no effect on net income when company buyback is shares from reserve, but it will fall. So as you know, if you buy back our own shares from if you buy back our own shares from the cash reserve, there is no effect on the net income until unless you will issue a debt. So you have the additional point. Stock dividends involve transferring a portion of retained earnings to contribute capital with the same amount. So as you know what a stock dividend is, that is the market cap will remain same. It's like giving cash instead of like it's like giving stock instead of giving cash as dividend. So what is homemade dividend? An investor has 100 shares of land and don't pay dividend. So the investor can sell a portion of portfolio like it. As we have studied in the earlier LOSs, like in a world where there is no taxation. So nobody wants to get a dividend as a stable of monthly income. Like if the shares can be buy and sell at a very low quantities like uh, 0.10 of a company or 0.20 basis of a company. So investors don't want a dividend as a monthly income, so they will go into the affiliate and sell a percentage of shares. That is permanent dividend. That third one is the share repurchase provided greater flexibility to management. Then payment of cash dividend, as cash dividends are fixed and quarter to quarter, but repurchase can be done according to the profit, as we have mentioned earlier. That the company usually don't prefer giving dividends because we don't want to commit to pay dividends in the future. Paying dividends increase agency conflict. Dividends increase the default risk of debt. So there is always a conflict between the shareholders and the bondholders. The bondholders wants the company to reserve its shares. So in the time of when the company is not doing good, this this cash reserve also acts as a cushion to the debt holders. But the shareholders wants this cash reserves to be given to them in the form of dividend. An open market repurchase is the fastest method to stop stocks downturn. So if the shares are falling drastically for a period of days, so to overturn this momentum, the company can buy back its own shares from going directly into the exchanges. This will reverse the chart pattern of the stock. If there is a uncertain increase in sales, the company should declare special dividend. So as the investors know that this is a special dividend and this is not a commitment dividend. So negotiated repurchases receive share at a discount rate. Suppose a company wants to the company wants to buy back its share from a large institutional investor. So they can negotiate on a price. Usually this negotiation occurs at a discount price.